Stocks post a mixed close on Monday as tech continues to outperform while the Dow logged a fifth straight losing sessions. The Nasdaq gained less than 1 full point on Monday, rising 0.645 points, or 0.01%, while the S&P on the earnings side, notable results expected out Tuesday include Oracle, ORCL, and FedEx, FDX, which are both expected to report earnings after the market close. FedEx earnings after the market close on Tuesday will be a highlight on the investing schedule, which remains fairly quiet this week. Reuters, COTS for PEM held good in the bad of the stock market after 2017's cool, calm, and collected rally in the stock market. 2018 has been a different story. Earlier this year, the market entered a correction, defined as a 10% drop from its high, and while each of the major averages is still higher year-to-date, the Dow and the S&P. Against this mixed backdrop for the market's overall price action, there still remain a number of positive signs for the market, including earnings, the economic outlook, and the market's recent price action. But we're calling the backdrop mixed because there are also a number of reasons for investors to exercise caution. In a note to clients published last Friday, the team at Bespoke Investment Group gave a quick overview of the good and the bad for the stock market right now. On the positive side, Bespoke cites strong earnings and guidance, an epic job market, and few signs of the economy nearing or entering a recession is supporting the stock market right now. Over the balance of the year, So although the market had just a so-so run through earnings season, a continued solid run for U.S. corporates should underwrite a thesis that stocks are a good buy. Earnings trends remain strong and guidance has now been more positive than negative in 5 straight quarters. Source: Bespoke Investment Group. Meanwhile, as we've chronicled at length in recent days, the U.S. job market and economy show few signs of slowing, and until we begin to see an uptick in initial jobless claims or an outright decline in the number of jobs created each month, this trend would appear solidly in place. A potential headwind for the market right now comes from a group of stocks we seemingly think and talk about every day, the FAANGs. Bespoke notes that these high-flying tech stocks have more than doubled their percentage of the global stock market cap over the last 5 years as technology's weighting in the S&P. Additionally, global economic growth is slowing down after 2 strong years, with manufacturing activity leveling off and trade volumes falling sharply as the Trump administration looks to reshape the U.S. economy's relationship with its key trading partners around the world. Manufacturing activity has leveled off in recent months while global trade volumes dropped sharply amid recent actions from the Trump administration to alter the U.S.'s agreements with its major trading partners. Source: Bespoke Investment Group. The Federal Reserve's plans to raise interest rates over the next couple years also cannot be overlooked by investors. Futures markets are pricing in a Fed that will stop raising rates when the Fed funds rate hits 3%, though the Fed's own forecasts expect benchmark rates to exceed this level in 2020. Over the last 18 months, the market has underestimated the pace at which the Fed would raise rates, and a market that continues to lowball the Fed's actual interest rate decisions could end up with more bouts of the instability we saw earlier this year, when it seemed investors all at once realized they had misread the Fed. Miles Udland is a writer at Yahoo Finance. Follow him on Twitter at Miles Udland.